You mentioned their exposure in China as well. Then we look at the international footprint as well of DBS, especially the exposure to China. Is there anything that might be concerning, or is the balance sheet and is DBS itself strong enough to at least withstand some of the ongoing uncertainties from this very big market?
No, actually, all of the Singaporean banks are very comfortable with their China exposure. The China exposure, in any case, for DBS is largely to super large corporates, SOEs, some amount of financials. So zero concern, frankly, in terms of their China exposure.
Right. One thing to also note here is that they were put on a bit of a timeout by the MAS for that big system outage that they encountered sometime in October, November. 6 months, you can't do anything with your IT services, you can't go into new business ventures. That seems to have been lifted as of yesterday, actually. What does this open up for DBS in terms of opportunities? Does this allow them to shift up a gear, for instance, with regards to other parts of their business, for instance?
So DBS has always been looking out for growth in opportunistic areas. So they've been looking at putting in more money into their India venture, the ex-Lakshmi Vilas Bank, into Shenzhen Rural Commercial Bank. So all of those new extra equity being put into different parts of the business to grow it. Maybe that was something that the MAS was not allowing them to do. So it's just more business as usual, as well as to look opportunistically at what's out there and what they can do. So the good news out of this is that the MAS has said, okay, we're satisfied with all the steps that DBS has taken so far, and so we take them out of the naughty corner a little bit, so that they can then, get on with what it is that they're supposed to be doing.
Pramod, very quickly, you're a credit analyst, I know, right? When you take a look at the quality of DBS's book, how does it look?
All three of the Singapore banks look fantastic, and that's the reason, from a credit rating agencies, they're in, the best bucket that there is, unless you're AAA, so they're all AA1, AA kind of category. One thing that all the banks have been surprised by over the last 18 months or so is that they would have expected to see some cracks somewhere with the higher for long interest rate environment, and that's kind of constantly being pushed back, right? So even if we were, say, in 2022, what we are expecting is that, about 18 months later, we're going to see an increase in special mention loans. About 21 months later, your non-performing loans will start creeping up. We've actually seen none of that, right? And credit quality is about as pristine. And, we look all across the Asia sector, taking a step back. I think the good news on credit quality in Asia as a whole, and all of the Singapore banks are kind of exposed to Asia credit, is that GDP growth has been quite good in developing Asia, and in developed Asia, unemployment rates have been low. So that means that the factors that can cause issues are not really causing issues, which is that things are out of line, growth is out of line, cash flow is simply not happening, either in developed or developing Asia. That's okay. And so we haven't really seen that reflected pretty much anywhere. The only sector that we were a little concerned about was Korea household lending, and that's not something that the Singapore banks were exposed to. But even in that space, what the government has done is that for those coming off mortgages, fixed rate mortgages into floating rate, they have provided a special scheme where they can get mortgages at 3.5%. That's substantially lower than the market rate, and that has ensured that, again, household leverage is manageable and there's no risk there. So frankly, across Asia, we're not seeing too much of trouble.
Well, let's hope it's not a 25 story. Pramod, listen, we got to go. Fantastic talking to you. Appreciate the time. Thank you. Keep safe. Come back and see